Ontario just changed the rules for every landlord in this province, twice, effective this year. At the same time, asking rents are going down $200 a month from their peak. Canada's population already shrank in 2025. And two major GTA malls just entered creditor protection with $500 million in debt between them. This is not a slow news week. This is a market telling you something. The question is, are you listening? I'm Addy Saeed, licensed real estate broker with REMAX Gold Realty, partner at Westcliff Asset Management and Westcliff Living. And I've been doing acquisitions, developments, and asset management across GTA, Hamilton area, KWC, and Niagara for nearly 20 years.
And I'm Ribhu Rampersad, mortgage agent level 2 with BLD Financial, CMHC and MLI specialist, active investor across 20 to 30 unit value-add properties across Ontario.
This week, we're breaking down 8 stories that every Ontario investor needs to understand. We've got direct policy changes hitting July 1st and September 21st of this year. We've got rental market data that challenges assumptions. A lot of investors are still underwriting to. We've got macro rate signals from RBC Economics, infrastructure investment in a high growth corridor, 2 suburban malls, CCA filings that are land stories as much as they are retail stories, and a massive brokerage merger that hits close to home for me personally. And Teranet data on where Ontario housing market actually stands right now. We're going to move fast. Every segment has takeaways you can act on. Let's get into it.
Before we start, if you're not already on our platform, go to learninvestmanage.com and sign up. Completely free, no credit card, no payment required. You'll get access to all our underwriting tools, and we'll send you a personal invite to our school community where you can connect directly with other investors also doing deals in Ontario. The link is in the show notes. And now let's get into the content.
We're starting here because it is one of the most time-sensitive stories this week. On April 27th, this past Sunday, the Ontario Ministry of Municipal Affairs and Housing issued an official memo confirming RTA's amendment coming into effect in 2 waves, July 1st and September 21st of this year. These come from Bill 97, the Helping Home Buyers, Protecting Tenants Act from 2023, and Bill 60, the Fighting Delays, Building Faster Act in 2025. Both bills have been sitting in various stages of implementation. Now we have confirmed dates. Let me walk through what exactly is changing. 3 changes hit July 1st. First, air conditioning. Tenants will now be explicitly permitted to install windows and portable air conditioning units if you, as the landlord, don't supply air conditioning. There are installation conditions. It has to be safe and secure. But if you're obligated under the tenancy agreement to supply electricity to the unit, so as a landlord, if you're providing power, you can charge a seasonal rent to increase the offset of cost. The specific rules around this increase aren't fully detailed in the memo. So before you act on this, review the full Schedule 12 of Bill 60. Second, rent-arrears agreements. If you work out a payment plan with a tenant for arrears, you now must use the Landlord and Tenant Board's approved form. An informal side agreement, a text message, a handshake deal, won't cut it anymore at the hearing. This is actually a protection for landlords who have historically lost cases because their arrear agreements weren't documented properly. And number 3, and this one matters, fines just doubled. Individual landlords' maximum fines under the RTA goes from $50,000 to $100,000. Corporations, $250,000 to $500,000. If you're operating through a co-op structure and you're not running a tight compliance operation, this is the number you should be getting attention to.
Addy, on the fine increase specifically, for investors who own multiple units in a holding company, what does that compliance exposure actually look like? What kind of violation would get landlords into that territory in the first place?
It's a great question. The violations tend to attract fines at this level. Things like illegal entry, which is very, very common, entering the unit without proper notice, harassment, interfering with vital services such as heat and hydro, or retaliatory evictions. For most mom and pop landlords operating 1 or 2 properties, the risk is low if you're following basic protocol. But for anyone running a portfolio of 10, 15, 20 units through a corporation, the exposure is real. One bad property manager, one undocumented maintenance situation, one improperly served notice, and you're not fighting a $50,000 fine anymore. You're fighting a $500,000 fine. The operational discipline has to match the scale of the portfolio. 3 more changes coming effective September 21st, and these are bigger. First, personal use evictions. Currently, if you want to move yourself or an immediate family member into a unit, you give 60-day notice and you have to compensate the tenant 1 month's rent. Under the new rule, if you give a 120-day notice, so that's 4 months, double the minimum, that's compensation requirement goes away. You also no longer need to offer the tenant an alternative units. Ribhu, I want to come back to you on this one because there's financing and deal structuring angles here.
Absolutely. Flag it. We'll dig in.
All right. Second, renovation eviction or renovictions. This one cuts both ways. If you're ending a tenancy to do a major repair or renovation, you now have strict written notification requirements. You need to provide the estimated completion date in writing, notify the tenant of any changes to that timeline, and give them a final date the unit will be ready. After completion, the tenant has a minimum of 60 days to reoccupy. A minimum. And here's the part that matters to anyone thinking about value-add renovations. The tenant's window to apply to the landlord and tenant board if they feel their right of first refusal was denied is extended to the later of 2 years from when they vacated or 6 months from renovations are completed. So even if it took you 3 years to complete the renovation, they still have 6 months to come back to you. That is a long tail of potential liability. Number 3, and this one landlords have been waiting for. Non-payment eviction notice have been cut from 14 days to 7 days. Effective September 21st, if a tenant hasn't paid rent, you can serve them an N4 after 7 days instead of 14 days.
Wow, that's great. But let's go back to the personal use eviction chain. For investors buying a small multi-unit properties, like a triplex, fourplex, and their strategy involves eventually moving a family member in or repositioning a unit, how does this 120-day notice thing change their approach? Does it actually make that a bit more viable?
I would say the opposite. I think it makes it more predictable, which is almost as valuable as making it easier. Before this change, you gave 60-day notice, you paid compensation, and you still face the risk of a bad faith application to the LTB, tenants claiming that it wasn't a genuine personal use. And also, you had to find a unit too. And now, if you're willing to give a 120-day notice, you've removed the compensation cost entirely. And for an investor buying a triplex where one unit is below market, the math on the personal use eviction just got cleaner. You're trading time for money, 120 days versus a month compensation payment. For most investors, that's worth it. The risk that doesn't go away is the bad faith application risk that is still there. If you evict for personal uses and the unit is back on the market within 12 months, you're exposed. That hasn't changed.
From a mortgage and deal structuring perspective, these changes would really matter at the underwriting stage. Typically, when I'm looking at a value-add acquisition, one of the questions lenders typically ask is, what is your vacancy and turnover assumptions? What do they look like? So if your strategy includes renovating occupied units, the extended right of first refusal window and the documentation requirements will add another layer of operational risk that would definitely need to be priced in. A 60-day reoccupancy window plus the 2-year LTB application window means you need to document every step of that renovation process, like you're going to be challenged on it. You might be 2 years later, and that's going to really impact your bottom line.
So key takeaways. July 1st is 64 days away. If you pay tenants electricity and don't supply AC or air conditioning, review your tenancy agreements now. The seasonal rent increase option exists, but the rules need to be followed precisely. Number 2, corporate landlords face $500,000 maximum fines under the RTA effective July 1st. Compliance documentation is no longer optional at scale. It's financial risk management. And number 3, September 21st brings the 7-day non-payment notice, operationally significant in a worsening rental market. But faster notices does not mean faster hearing. LTB backlog is a separate problem this memo doesn't solve. Something worth watching. The memo explicitly states that the effective dates for the remaining Bill 97 and Bill 60 charges are still to be determined. What other provisions are still in queue? And could any of them materially shift the landlord-tenant balance further? Something else worth watching is the 7-day non-payment notice accelerates the filing timeline, but with landlord and tenant board hearings backlog still significant. Does faster notice actually translate into faster solution, or does it just move the bottleneck, or does the bottleneck get bigger?
So those policy changes don't exist in a vacuum. They're landing in a rental market that looks very different than it did 18 months ago. Addy, let's talk about what's actually happening on the ground with market rents.
The Financial Post just ran a story this week that I think is the most important read of the week for Ontario apartment investors. The headline is about homeowners being squeezed, but the data underneath, it is about a fundamental shift of rental demand that affects every investor in this room. Here are the numbers. Canada's population declined by 102,000 people in 2025, a 0.2% decrease. That's the first population decline ever recorded in this country. Between 2021 and 2023, we were adding roughly 1 million people per year. The federal government reversed immigration policy in 2024. Fewer foreign students, fewer temporary workers, and the population math flipped. Asking rents in Canada have dropped approximately $200 a month since their early 2024 peak. They're still at $300 to $400 above pre-pandemic levels, but the direction has changed. And landlords who are offering zero incentives 2 years ago are now offering 1 to 2 months free rent to attract tenants. The article follows one investor, who we'll call him Josh, who bought a $1.3 million property in Toronto with a basement unit, raised his rent 30% between the first and the second tenant. Then, when his second tenant moved out in mid-2025, he almost got no application, reduced the rent from $19.25 to $17.65. took until year end to fill this unit. That's the market.
Wow. So Addy, you're active in acquisitions across KWC, Hamilton, and Niagara. Is what the financial force describing like GTA specific, or are you seeing some rentals softening in the secondary Ontario markets as well, where a lot of our listeners are looking to buy?
It's not uniform, and that distinction matters. The softness is most pronounced in the GTA condo market, specifically investor-owned condos that are competing with wave of new supply. Purpose-built rentals in secondary markets are holding up better because the supply pipeline is thinner. In markets like Hamilton, Kitchener, you're not seeing the same inventory flood as Toronto is dealing with. But the demand side, immigration-driven population growth, that's a national story, not a local one. The rental demand cushion that made everyone feel like the market was bulletproof, that's thinner everywhere, and some places completely gone.
So I think there's two forces hitting simultaneously here, and I want to separate them because they have different implications to how you underwrite. So force one is demand. Immigration policy completely reversed population growth. Fewer people entering the rental market. So this is policy driven. It's a reversible factor. And if immigration targets change again, demand comes back. And even CMHC's Jordan announced he called the current softness temporary and projected a reversal in 2027 to 2028 as condo supplies dry up. But force two is supply. Developer built condos that couldn't find buyers and are flooding the rental market. The article is very explicit on this, and units built to sell are now listed to rent because developers are trying to recover carrying costs. This is also temporary, but once that inventory gets absorbed and new condos start remaining suppressed, the supply pressure is going to ease. But the problem is the timing. Both forces are hitting at the same time. And the investors who are the most exposed are the ones that Gus Papiano from Realosophy named directly. Peak buyers from 2021 to 2023. Bought high, rates went up, rents came down, and it's a triple compression that a lot of balance sheets just can't handle.
Yeah, you're absolutely correct, Ribhu. From a mortgage perspective, what does refinancing actually looks like right now for somebody who bought a $1.3 million property in 2022 at rates that were a fraction of what today's are? Walk us through the math and what that renewal looks like when rental income is also dropped.
So I'll be direct. It's painful, man. Someone who bought in 2022 at a 1.5 to 2% variable rate on a $1 million mortgage was carrying about $4,500 to $5,000 a month. Coming up for renewal, call it 4.5 to 4%. On the remaining principal, it could be like $5,500 to $6,000 a month or higher depending on the amortization. At the same time, the rental income has declined. And the article itself cited landlords absorbing $700 to $1,000 a month in shortfall. Add renewal shock on top of that, some of these investors carrying $1,500 to $2,000 a month, more than they underwrote for. That's a big financial decision point at that point, not a rounding error. Some are selling though, and that's what we're seeing. Some are selling, the ones with deeper pockets, and the article says it directly, are choosing to hold for 2 years and wait for the reversal. Whether that's the right call really depends entirely on their personal balance sheet, their rate at renewal, whether they believe the CMHC 2027-2028 thesis, but it's going to be interesting to see how it all plays out.
And it's interesting to say that this is exactly where purpose-built rentals has a structural advantage over the condo investor model. A large purpose-built operator can absorb a couple of months of vacancy without panic. An individual investor who has one unit and a tight mortgage can't. CMHC's Nanowski said this directly. Individual condo investors are more likely to make concessions and accept lower rents because they can't stomach the vacancy. That price-taking behavior is what's driving the asking price down. The purpose-built operator aren't the ones discounting. It's the individual investor. So there's a couple of takeaways over here. Canada's population has declined 102,000 people in 2025. The first population decline ever recorded. This is not a rumor or a trend. It's Statistic Canada data. Underwriting assumptions built on continuous population growth needs to be revisited. Number two, asking rents are down from $200 a month from its peak, but still $300 to $400 above pre-pandemic levels. The floor is real. The direction is the concern. And it's being driven by two simultaneous forces, demand contraction and supply flood. And number three, CMHC projects a reversal in 2027 and 2028. This is a credible forecast, but it is a forecast. 2 years of carrying costs at today's rates is the price of being right, but early. Something worth watching. GTA condo vacancy rose from 0.7% to 1% in 1 year, a 43% increase in relative terms. If the trajectory continues through 2026, at what point does the vacancy rate start materially affecting cap rate assumptions for condo-heavy portfolios? Something else to watch. CMHC's 2027-2028 reversal thesis is based on new condo supply drying up. But if purpose-built rental completions accelerate, several large projects are in the pipeline, does that supply offset push the reversal timeline further out? The rental market softness we just talked about isn't a surprise when you look at Teranet housing transfer data. It shows up in numbers. Let's look at what's actually happening with Ontario's ownership market, because it connects directly with where the distressed sellers are going to come from.
So Teranet held their Property Ecosystem Summit in Toronto on April 21st. Their VP of Finance, Trevor Appleton, presented what had called the most detailed transfer-level housing data we've seen in one place this year. Not survey data or sentiment data, it's actual registry data. When properties change hands, at what prices, to whom. There's a few numbers that tell the story. A new-built condo transfers in Toronto dropped 11.9% in 2025. Resale condos fell 2.4%. Power of sale transactions in Ontario are now more than 5 times higher than their 2022 low. And condos are driving a large portion of those. Multi-property owners, so investors, are down to 21.5% of transfers from 23.8% in 2021. But here's the nuance though, they are still transacting. They're just doing it with smaller portfolios, less leverage, and a sharper focus on quality. 55.2% of multi-property owners own exactly 2 units. Only 7.5% own 10 or more. Properties purchased in 2022, specifically 2022, have the highest elevated rates of selling at a loss across all value ranges. That's the peak buyer cohort we talked about in segment 2 showing up in actual registry data.
Ribhu, the power of sale number is striking, 5 times the 2022 low. But Appleton was careful to say it's not a meaningful volume. Banks are working with clients to avoid the outcome. From a mortgage perspective, what does a bank behavior actually look like? And when does working with a client stop being viable?
Well, ultimately, banks don't want to be in the power of sale business. It's operationally expensive, it's reputationally sensitive, and in a declining market, they often recover less than face value. So the default behavior is extend, pretend, and give the borrower a payment deferral, extend the amortization, accept interest only for a period of time, whatever buys time for both sides. The threshold where that stops working is when the loan to value goes and deteriorates to a point where the bank security now is genuinely impaired. If you bought at $800,000, the property is now worth $650,000, and you've been carrying the loan on deferrals, the bank's math is going to change. They're no longer protecting a recoverable asset. They're managing a loss. That's when power of sale becomes the preferred outcome. Now, I don't think we're there at scale yet. Appleton's data confirms that, but the trajectory is headed towards more of it, not less. And the 2022 buyer cohort is a watch list for sure.
The other data point I want to flag from Teranet is the holding period data. Average holding period for condos in Toronto is now 8.6 years, up from 6.7 in 2016. For non-condos in Toronto, it's 17.7 years. That's extraordinary. People are not selling. And the GTA in migration numbers, the percentage of people moving into the GTA hit a 15-year low in 2025. So you got a market of people where people aren't moving in, people who are in are not selling, and transactions are declining. But the properties that are selling are increasingly selling at a loss if they are purchased in 2022. Appleton called 2026 transitionary and said things open up in 2027. That's consistent with CMHC's rental thesis. The question for investors is, what do you do with 12 to 18 months of transitionary market?
From an acquisitions perspective, transitionary market creates motivated sellers. So Addy, where are you actually seeing deal flow come from right now? Are the distressed sellers showing up or are people just holding?
Both. It's not uniform. The sellers who are showing up are the ones who have a hard deadline. Mortgage renewals they can't service, partnership dissolutions, life events, estates, divorce, relocation. These are all genuinely motivated sellers. Those investors who are simply underwater but don't have a hard deadline, they're holding, which means the distressed inventory is there. It's not flooding the market all at once. You have to be positioned to find it. Relationships with receivers, power of sale specialists, lawyers handling estate files. The deals are not going to come to you through MLS. So we have a couple of takeaways again from this segment. New built condo transfers in Toronto fell 11.9% in 2025. The investor math that drove condo pre-construction purchases in 2021 and 2022 has been broken down, and the registry data confirms it. Number 2, power of sale is rising, but not yet at systemic levels. Banks are working with borrowers. The stress is real, but it's being managed. The 2022 buyer cohort is the population to watch. And number 3, distressed deal flow exists, but requires proactive sourcing. MLS will not surface the best opportunities in the market. Relationship with receivers, estate lawyers, and power of sale specialists are the acquisition's edge. Couple of follow-up questions. Something worth watching. So multifamily owners are shifting from quality over quantity with less leverage. Does that mean sub 3 million multifamily segment where most retail investors compete becomes less competitive as institutional capital focuses elsewhere? Or does it mean that we're going to have more competition from well-capitalized individuals downsizing from larger portfolios? Any thoughts, Ribhu?
Yeah, I think it's going to become a lot less competitive in the sub $3 million multifamily segment. I think a lot of the institutional players are going to start trading up and improving their own operational efficiency by managing larger assets. What we're also seeing from a lending standpoint is a lot of lenders reducing their appetite, especially in the small CMHC loans. It's getting tougher and tougher to get high leverage under $3 million loan amount. So I think that's going to transition a lot of the institutional investors to bigger deals.
Interesting. On the other side, we also have average holding periods in Toronto for non-condos at 17.7 years. That just blew me away. If people are holding longer, transaction volumes stay suppressed, which means price discovery is limited. How do you underwrite a market where comparable sales data is increasingly stale?
Yeah, you're going to have to be extra conservative with your underwriting. I think really being prepared for a bear case scenario is the only way to get into a deal right now, knowing that you're going to try to operate above that number. But ultimately, you need to be okay with the downside coming true.
All that market context exists within a specific financing environment, and the Bank of Canada posture for the rest of 2026 is one of the most important inputs to any acquisition underwriting right now. Ribhu, walk us through what RBC Economics is saying.
So, RBC Economics published their forward guidance report for the week of April 20th. Authors are Nathan Jansen, Assistant Chief Economist, and Claire Fan, Senior Economist. This is as credible a source as you're going to get for near-term rate and inflation forecasting. And the headline, RBC's base case is the Bank of Canada holds the overnight rate at 2.25% all through 2026. No cuts, no hikes, just stable. March headline CPI is projected at 2.5% year over year, up from 1.8% in February. Now that increase is driven almost entirely by 21% monthly surge in gas prices. But here's a critical distinction. Core inflation, which strips out energy and food, averaged just 1% annualized from December through February, which is well inside the bank's target. That's the number the Bank of Canada is actually watching. But April is where it gets more interesting. RBC is projecting headline inflation breaks above 3%, the top of the Bank of Canada's target band, driven by continued energy pricing pressure. And the federal government suspended the fuel excise tax at 10 cents per litre effective April 20th, which blunts some of that, but the projection still puts April above target.
So, Ribhu, for an investor underwriting an acquisition right now, what does rates on hold at 2.25% through 2026 actually mean in practical terms? Walk us through what anchors the financing side of this deal.
What it means is you have a planning horizon. When rates are moving, when the next decision could be a cut or a hike, underwriting financing costs is genuinely difficult. You're stress testing against a range of scenarios. And when the base case is a hold for the next 8 months, at least you have a number to work with. At 2.25% overnight, variable rates mortgage are pricing in the low 4%, probably even high 3s, conventional financing. And CMHC insured deals, MLI Select, are in the high 3s depending on the lender and the deal structure. That's your cost of capital. The risk is that 3% April CPI number. If energy prices don't moderate, if that bleeds into core inflation measures, the Bank of Canada will lose the flexibility to stay on hold. One bad inflation print is enough to reprice the conversation. RBC flags this explicitly as a key risk to their base case. So they're not dismissing it. They're just saying it's not that central scenario, but they are watching it.
So what's the spread doing between fixed and variable right now? For an investor acquiring in this environment, is there a case for locking in, or does the whole thesis support staying variable?
So the spread had compressed, and then given the geopolitical conflicts over the last couple of months, it has widened yet again. When the Bank of Canada was cutting aggressively, variable looked attractive because you were riding the rate cuts down. Now, with a hold through 2026, potential increases in 2027 as RBC's base case, the math is a bit different. However, since the increase in fixed rates, given the change in geopolitical situation, you're seeing between a 50 to 60 basis point spread between fixed and variable rates right now on the residential side. Now, the question becomes a little bit more blurred again. That being said, I still think the fact is for a long-term hold investor who wants cash flow certainty, fixed still makes sense. For someone with a shorter horizon, a value-add strategy with a clear exit, variable will still give you flexibility. But my honest answer is it depends on your specific deal, your LTV, and your refinancing timeline. There's no universal right answer in this environment. And what I tell clients is stress test both. If the deal doesn't work at 5.5%, probably shouldn't be doing it at 4% either.
So some great takeaways from this article. Number one, Bank of Canada base case hold at 2.25 through all of 2026. This is your underwriting anchor for financing costs. It's not guaranteed, but it's the most credible current forecast from a major bank economics team. Number two, core inflation is well behaved at 1% annualized The energy-driven headline number is noise for monetary policy purposes until it isn't. Watch for April CPI data. And number 3, stress test your deal at 5.5%. If the numbers only work at today's rates, the deal has a rate risk embedded into it that needs to be priced in. So something worth watching. RBC's base case assumes rates holding 2026, then gradually increases in 2027. If that 2027 increase coincides with CMHC's rental reversal thesis, rising rates mean rising rents. What does that mean for cap rate compression in Ontario multifamily? Any thoughts, Ribhu?
I just don't know.
Look, I don't think you're going to see rental rate compression, but you will see rising income. So your rates are rising, but if your rents are rising, you'll see income rising. So your cap rates, even if they remain the same, the valuation would be increasing.
Yeah.
The other side of it is the fuel excise tax suspension is a one-time policy tool. When it's reinstated, the inflationary impact reverses. How does investors factor temporary policy interventions into inflation assumption when underwriting long-term hold assets?
Now, that one I think is a big challenge because I feel that policy changes are so volatile, but there's really no way to predict. And I think that just boils down to ensuring you're buying an asset with good debt servicing. So you have the buffer to withstand the ever-changing policies that we face from a day-to-day standpoint. Sometimes good, sometimes bad.
No, and I agree. I think we shouldn't be taking it into consideration as a discount. Like if you see a policy coming into play that is beneficial to you, you shouldn't be actually accounting for it in your underwriting because it can go away.
Yeah.
Mind you, if there's a larger policy, that's a different story. But like CMHC is a policy as well, right? So you shouldn't be discounting it, but at the same time, you shouldn't be relying on it heavily either.
For sure.
So quick pause here. If you're finding this useful, learninvestmanage.com is where we put all of our tools. Sign up free, use the underwriting calculator, join the community, link in the show notes. Let's keep going. So I want to shift the conversation for a moment because everything we've talked about so far is about stress, rental softness, distressed sellers, policy changes, rate risk. That's the real picture. And we don't want to sugarcoat it here. But sophisticated investors don't just read stress signals, they read infrastructure signals. And the Ontario government issued one this week, and I think it's getting underreported in real estate circles. On April 27th, the province announced $10 million to advance planning for a new acute care hospital in East Gwillimbury, near the future Bradford bypass, plus a major redevelopment of South Lake Hospital in Newmarket. Together, these projects serve about 250,000 plus people across northern York Region and southern Simcoe County. Now, I want to be precise about what this is and what this isn't. $10 million is planning capital. Bed counts and square footage, nothing confirmed yet. There is no construction schedule. This is early stage, a hospital that's in early planning, but could be a decade away from opening.
So Addy, you've done acquisitions across this corridor. East Gwillimbury, Bradford, Newmarket, Aurora. What's the current state of the multifamily market in that northern York region? And does infrastructure like this actually move the needle on rental demand, or is it too slow moving to factor into a near-term underwriting model?
Look, northern York region is one of the fastest growing corridors in Ontario. That's not an opinion. That's consensus data. East Gwillimbury specifically has been one of the fastest growing municipalities in Canada by percentage growth for several years running. The infrastructure is trying to catch up to the population, not the other way around. For near-term underwriting, no, a hospital in early planning stages doesn't move your rent assumptions today. But here's how sophisticated investors think about infrastructure. It's a demand floor. It tells you in 10 years, this geography has a sustained employment base and a population need of housing. That affects the exit assumptions, your cap rate assumptions at sale, and your confidence in holding the property through market cycles. The Bradford bypass connectivity adds to that. You look at road infrastructure, healthcare infrastructure, and population growth trajectory at pointing in the same direction. That's not speculative. That's a planned growth. From a financing perspective, do lenders differentiate between growth corridor markets and stable markets when they're underwriting multifamily acquisitions? Is there a premium on CMHC or conventional financing for assets in high growth geographies?
So on the CMHC and MLI Select side, the underwriting is primarily income-based. Property's debt service coverage ratio, the vacancy assumptions, the rent roll. So geography matters in the sense that CMHC will look at market vacancy rates for the area. And in high growth markets with low vacancy, that generally supports better financing terms. Conventional lenders, though, they are a bit more nuanced. Some lenders will apply a growth premium to markets with strong population fundamentals. It affects their LTV appetite and their view on that long-term security. But I'd be careful about over-indexing on that. The best underwriting story is always the income the property is generating today, supported by a credible view of where that income goes tomorrow. So infrastructure signals support that tomorrow story, but they don't substitute for the today story.
Points well taken. So we got 3 takeaways from this story. A $10 million in planning capital is not a construction announcement. This hospital is years away. Don't underwrite rental demand on infrastructure that hasn't been built yet. Number 2, infrastructure signals matter to exit assumptions, not entry assumptions. If you're buying in the Northern York region corridor, the hospital announcement supports your 7 to 10-year hold thesis. It does not change your year 1 cash flow. And number 3, East Gwillimbury and Bradford are planned growth corridors, not speculative bets. The Bradford bypass, provincial healthcare investment, and consensus confirmed population growth are institutional quality signal. So something worth watching. The new hospital site is near the future Bradford bypass, which is itself still in development. If either project faces delays, does that affect the growth thesis of the corridor? What's the minimum infrastructure threshold before this geography re-rates itself as a primary market? Any thoughts, Ribhu?
I think that's kind of hard to define because I feel like there's a lot of communities that have seen hypothetical growth. There's a goal line coming, or there's a hospital coming, or there's a data center coming. I don't think it necessarily materially moves the needle until things are well along its way, because I feel like Canadians have come to terms with the fact that we have long execution timelines.
And let's not forget the Eglinton line, okay?
Yeah.
It gets an honorary mention. Anytime there's timelines being mentioned, the Eglinton line, oh God, like what, 10 years over its schedule? It gets an honorary mention.
Yeah.
Another point worth noting is Northern York region has significant greenfield developments underway. Purpose-built rental supply is growing alongside the population. Does increased rental supply in the corridor offset the demand signals from infrastructure movement or infrastructure investment?
No. I think if we look at different other markets like Milton or other areas whose growth has come alongside infrastructure investment, I think it's always been very promising for those areas. I don't know if the increased rental supply will actually offset the demand signals. I think once that momentum hit, it could be great opportunities for everybody who's well positioned in those markets.
As long as we see a reversal in the immigration story.
Fair.
Because if we don't see that, then all of this is for null because we're not going to be growing.
Fair enough. So infrastructure signals tells you where growth is going. Distress signals tell you where capital is stuck. And right now we have 2 very large pieces of capital stuck in the suburban GTA retail. So Addy is the mall story.
So we've covered both of these properties on this platform. We did a piece on the Dixie Outlet Mall back in March when it entered receivership. And this week, Woodbine Mall filed for CCAA protection. Now that we have both of these in front of us, I want to talk about them together because individually, they're property stories, but together, they're a market signal. So Dixie Outlet Mall, Mississauga, the receiver appointed March 2nd, Alvarez and Marshall. Owner is Slate Asset Management and has over 100 tenants still operating: Nike, Guess, Winners, No Frills. The redevelopment plan called Plan Dixie is already incorporated into Mississauga's official plan 2051. 1,000 to 1,200 residential units planned in towers of 8 to 19 story, 365,000 square feet of retail retained, and 3.5 acres of parkland. Woodbine Mall, Etobicoke, Toronto, CCAA filing April 17th. Primary lender is Romsden Investment Corporation. Yes, the same Romsden, they were in the news just recently too. They're owed close to $500 million. That number deserves a pause. The property was under receivership since May 2023. Debt at that point was approximately $333 million. And now it's $500 million. That's $167 million in carrying costs accumulated while the property sat in limbo. Ernst & Young as receivers, 50 plus acres, I should say, near major transit, the Woodbine Racetrack District. City planning already envisions a dense, transit-oriented mixed use. What killed both of these assets is not mystery. It wasn't foot traffic. It wasn't the tenants. It was debt service against redevelopment timelines.
So Addy, Romspan is owed $500 million and is now moving to take ownership through a credit bid. For listeners who aren't familiar with that mechanism, what is a credit bid and what does it signal about Romspan's strategy here?
So a credit bid is where a secured creditor, in this case Romspan, bids their debt as currency for the sale process rather than cash. So instead of putting more money into the deal, they say we will swap out our debt for cash. Instead of finding an external buyer who pays $500 million, Romspan essentially says, we're owed $500 million, we'll credit that debt as our purchase price and take ownership of the asset. The reverse vesting order is a legal structure that allows the clean acquisition of the asset by leaving the liabilities behind. What it signals strategically is that Romspan couldn't find an external buyer willing to pay enough to recover their debt. So rather than taking a haircut in a traditional sale, they've taken the land. They believe that long-term value of a 50-plus acre in Etobicoke repositioned as mixed use is worth more than an arm's-length buyer would pay in today's market. This is long-term conviction bet.
From a financing and capital markets perspective, both of these situations illustrate the same fundamental problem. the mismatch between retail carrying costs and redevelopment timelines. Retail real estate generates income from tenants, but when you're repositioning a large suburban site, you're not running that asset for income, you're holding it for land value. The income from the remaining tenants doesn't cover the debt service on a $500 million loan. It doesn't even come close. So the clock runs, the debt compounds, and eventually the structure collapses. Retail expert Anthony Carabas said it directly in this Woodbine article, that there's a mismatch between how fast retail performance can deteriorate and how long redevelopment actually takes. It's not just a Woodbine problem. It's a Canadian secondary mall problem.
Ribhu, both sides have legitimate residential redevelopment potential. Dixie has planning in its official plan. Woodbine has city support, but we're in a soft condo market with tight financing. Does this residential exit thesis actually pencil right now? Or are these assets going to sit in restructuring limbo until the condo market reverses?
I think Dixie is in a stronger position than Woodbine on this specific question, and the reason is really around planning maturity. Plan Dixie is in Mississauga's official plan 2051. That's a meaningful distinction. Entitled or near entitled land has a very different financing profile than aspirational mixed use on a site that still needs full rezoning, especially in today's market. A developer looking at Dixie can model a much more predictable path to shovels on the ground. And Woodbine's city planning support is real, but support and approval are very different things. You still need rezoning, community consultation, infrastructure commitments, and with financing environment, lenders want that certainty of approval before they'll even underwrite construction. Without that, the residential exit is just feasible. Both sites will eventually redevelop. Question is whether the current ownership or the next ownership is the one that gets there. Rampersad taking advantage of Woodbine may just be the first transfer in a longer chain before a developer with the right platform and patient capital steps in.
So 3 takeaways from this one. So debt killed these assets, not retail. So Woodbine's debt grew from $333 million to $500 million sitting in receivership. That's the cost of carrying a large site through a long redevelopment approval process in a high rate environment. Every distressed asset investor needs to model this carrying cost explicitly. Number 2, planning maturity is the key differentiator between Dixie and Woodbine. Plan Dixie is in Mississauga's official plan. Woodbine's redevelopment vision is aspirational. And that gap affects financing, timeline, and exit certainty. Number 3, these are not multifamily apartment plays. These are large-scale, mixed-use development plays. Different capital requirements, different timelines, different risk profiles. Know the difference between them before you get excited about the land value. So something to watch. Rampersad is a private mortgage investment corporation, or a MIC, taking ownership of a 50-acre urban site through a credit bid. What's their exit strategy? And how does their capital structure as a lender turned owner affect the timelines and quality of this redevelopment? And also, if both Dixie and Woodbine eventually deliver 1,000 plus residential units each into their respective markets, Mississauga and Etobicoke, what does the supply addition mean for the rental market dynamics in those corridors and on timelines?
So these distressed asset situations don't happen in isolation. They happen inside an industry. And Addy, this week, the real estate brokerage industry itself had a major structural event that Addy is actually closer to than most.
I'll be transparent here up front. I'm a REMAX broker. REMAX Gold Realty is where I'm licensed. So when Real Brokerage announced Monday morning that it's acquiring REMAX Holding for $880 million US, that's not an abstract industry story for me. That's my brokerage. Let me give you the facts and then my read on what this means. Real Brokerage is a tech-forward, agent-centric brokerage with approximately 33,000 agents and a platform called ReZen. Transaction management, AI automation, integrated financial services. On the other side, you have REMAX Holding with over 145,000 agents across 120 countries. In Canada specifically, REMAX has about 25,000 agents and we have 925 offices. And earlier this year, we absorbed over 1,200 agents and 17 offices from Royal LePage. The combined entity will be called Real REMAX Group, headquartered in Miami, trading on the NASDAQ under REAX. Tamir Poleg from Real becomes the chairman and CEO. The deal is expected to close in the second half of this year. Pro forma combined revenue in 2025 was approximately $2.3 billion. Expected run rate cost savings are about $30 million annually, majority realized by 2027. REMAX brand continues. Motto mortgage continues. ReZen technology will be available to REMAX franchises, but it won't be mandatory.
Addy, set aside the brokerage politics for a moment. What is the deal this size at this moment in the market cycle? Tell you about the state of the for sale residential brokerage industry. What's the read through here?
So consolidation at this scale does not happen at the top of the cycle. It happens when transaction volumes are suppressed, commission pressure is real, and the only path to margin is scale or technology, preferably both. The for sale market in Canada and the US has been slow for an extended period of time. RENX said that plainly in their coverage. Realty business are acquiring or joining other brands to stay competitive. The $30 million in savings by 2027 is the other tell. On an $880 million transaction, that's a 3.4% cost synergy. That's not a transformational number. The financial case for this deal is built on revenue synergies, more agents, better technology, higher productivity. If those don't materialize, the math runs thin. But here's what I think the real bet is. Real believes Rezen is a platform that will make 145,000 REMAX agents more productive. If even a fraction of REMAX network adopts the technology and closes more deal, the revenue upside is real. Get it? Whether that happens depends on adoption, which is why not mandatory language around technology is the most important line in this announcement. Ribhu, there's a mortgage angle here that I want to make sure we cover. REMAX has Motto Mortgage as part of his franchise network. Real has integrated financial services through Real Wallet. A combined brokerage mortgage platform at this scale, does that change the referral dynamics for investors sourcing deals through brokers? And does it affect how mortgage professionals position themselves?
You know what? It's worth watching. Vertically integrated real estate and mortgage platforms have been tried before, but with mixed results. The theory is compelling. The agent finds the buyer gets the mortgage through the platform, the transaction is seamless, and everybody wins. But the practice is harder because buyers still shop mortgage rates and brokers still compete on relationship and pricing. See, personally, for me as a mortgage agent, it doesn't change my competitive position materially. My clients aren't coming to me because of a brokerage affiliation. They're coming because of expertise, access to lenders, and CMHC structuring knowledge. A technology platform doesn't replicate that. And for investors specifically, your sourcing relationships with brokers matter more than ever in a slow market. Your brokerage consolidation reshapes who controls the inventory flow, and it may. Your direct broker relationships are the asset, not the platform.
Amazing. So 3 main takeaways. Brokerage consolidation at this scale is a slow market signal. Real and REMAX aren't merging because the business is booming. They're merging because scale and technology are the only paths to margin when transaction volume are suppressed. Number 2, technology adoption is the swing variable. Reason being optional for REMAX franchises means that the platform synergies could take years to materialize or never fully materialize. Watch for adoption rates post-close. And number 3, your deal flow relationships are the assets, not the platform. In a consolidating industry, investors with direct broker relationships and access to off-market inventory are insulated from brokerage restructuring. Those without them are not. Make sure you connect. Reach out right away. So something else worth watching. REMAX Canada already absorbed 17 offices from Royal LePage earlier this year. Now the parent company is being acquired by Real. How many rounds of consolidation can the Ontario brokerage market absorb before agent count and office coverage starts to thin in secondary markets? And also, Real REMAX Group will trade on NASDAQ as REAX. As a publicly traded entity, quarterly earning pressures will shape strategic decisions. How does that public market accountability change the way the combined companies invest in technology and in agent support? So we've covered a lot of ground this week. Policy changes, market data, distressed assets, rate environment, infrastructure, brokerage consolidation. Let me close with what all of this collectively is telling us where the Ontario multifamily is right now. So 3 overarching themes of this week's contest. Theme number 1, the rental market thesis has been stress tested and it held, but with cracks. Population decline, immigration policy reversal, and condo supply floods have pushed asking rents down $200 from the peak. The floor is still $300 to $400 above pre-pandemic. CMHC sees a reversal in 2027 and 2028. The thesis is intact. The timeline is longer than people bought for. Theme number 2, the policy and regulatory environment is shifting in both directions simultaneously. The RTA changes coming July 1st and September 21st give landlord faster tools on non-payment and personal use evictions, but double the financial exposure on compliance failures and add procedural complexity to renovation strategies. This market rewards operators who know the rules. It punishes those who don't. Theme number 3, distress is real but not systemic yet. Power of sale at 5 times the 2022 lows, 2 major suburban malls in creditor protection, peak buyers under refinancing pressure, banks extending and managing. The 2026-2027 window is when the dam either holds or breaks. And that outcome depends heavily on whether RBC's rate hold thesis survives April inflation data and whether CMHC's rent reversal materializes in schedule. So here's the synthesis. Ontario multifamily is in a period of structural repricing. The investors who will come out ahead are the ones who can hold quality assets, Because the transition, source distress opportunities through relationships rather than listings, and underwrite with discipline rather than optimism. Key takeaway: RTA changes effective July 1st and September 21st are confirmed and imminent. Review your tenancy agreements, your arrear documentation, and your renovation strategies now, not after the deadline. Number 2, Canada's first ever population decline in 2025 is the most underappreciated risk factor in Ontario rental underwriting. Any model built on continuous population growth needs a population decline scenario stress test. And number 3, distressed retail to residential conversion is a real opportunity with a real timeline problem. Buzz debt grew $167 million by sitting into receivership. The land value thesis requires patient capital and a clear view of planning status before you enter.
So if you got value from this episode, subscribe wherever you listen and go to learninvestmanage.com. Sign up for free, get access to all our tools, and we'll send you an invite to our school investor community. No payment required. Just show up and start learning.
The investors who win in this market aren't the ones taking the most risk. They're the ones who read the data, know the rules, and underwrite every deal like the market won't bail on them. Because right now, it won't. Addy Saeed is a licensed real estate broker with REMAX Gold Realty and an OSC registered dealing rep. Ribhu Rampersad is a licensed mortgage agent, level 2 with BLD Financial, DLC license 12360. Both are partners or co-founders in entities referenced in this episode. The podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professional, much like us, before making any investment decisions. Past performance is not indicative of future results. We'll see you in the next episode.